Michael Johnson is a passive, and he is going, y'all are really, it's in for a treat. His presentation is top notch. Michael?
Everybody give Michael a hand. He's got a microphone. And I'm going to give you the clicker.
Uh-oh. Trouble. Can everybody hear me okay? Frank, am I good?
You're good.
All right. I'm a soft-spoken engineer. That's kind of why I ask.
Yeah, I'll make it a little bit louder. Oh, you can do it.
Yep.
I'll shut my mic off.
So Dave and I have done this presentation a couple times, and I always get a hard time from him. He doesn't understand my reactions. So I went out and I found some emojis. So they make emojis for engineers, right? So this is me when I'm happy. Where's the clicker? That's me when I'm sad, mad, amused, surprised. So just so we're clear.
Who understands engineers? Yeah.
Yeah. All right. So I hope that helps.
That was perfect.
All right. So I joined Lifestyles back in 2011. We had sold our home in Oregon in 2011. It was paid off, Dave Ramsey style. And so we had some cash, and I wanted to invest in real estate. My dad had given me the Rich Dad, Poor Dad book years before back in Oregon, but I didn't have a team. So Lifestyles gives you that team. Heard Dell on the radio, and that's one of the reasons why we came to that little seminar and got started. So I'm, like I said, a mechanical engineer from Oregon State University. I worked for Boeing for the first 8 years on the space station project, so I've got parts that are actually in orbit on the space station. I then had 2 kids. Both my boys were born in Alabama. That's where we were working, and they started talking Southern. So we decided to move back to where my family was back in Oregon.
Yeah, because they lost their teeth.
Yep. So we spent the next 21 years there. 2000, they retrained me to be a software engineer. So I finished my career in software. All that time, I'm doing the 401k, investing 12%, getting that company match. Thought I was doing great. 2000, lost half of it. 2008, lost half again. You know,
everybody remember that?
Yep, and it took 8 years to get back to where I was, and again,
it's not if it's going to crash, it's when,
yeah,
right? So
exactly.
we've all been through that, yep.
So 2009, we moved here, started listening to radio, heard Dell, and our lives changed. All right, so my first multifamily investment. So when we became preferred members, we were doing single family and multifamily at the same time. We ended up with 5 single family homes that we sold, and our results were similar to what you've already seen. We're going to focus on multifamily passive investing today. So my first deal we got into, back then it was hard to find leads. They were like purple unicorns. And we found one down at the case study, San Antonio, Jerry, and decided to get into his deal after just talking to him a couple times at case study. So he was buying a 360 unit property down in San Antonio. I still to this day have never been physically to this property.
I've been there a few times.
Thank you, I appreciate it. So this is back in May, it was when we closed. I had pledged $50,000, which is a lot of money for me, you know, as an engineer. Normally I'm buying stocks, you know, 2,000, 3,000, 4,000 at a time. This is 50 grand. About 3 weeks before closing, we get an email from Jerry saying, hey, a few people have dropped out. Do you want to increase your amount? I'm like, well, that doesn't sound good. You know, why are people dropping out? So we thought about it, and we increased to 80,000. So that's the, is there a pointer on here?
Yeah.
Hey, so that's the 80,000. So OOP, that's my out-of-pocket. That's the amount that I've invested. So a year and a half later, after he's taken the property from on the left side to the right side, he does a cash-out refi of 150%. So for that 80,000 in, I got a $120,000 check. So I was
happy emoji.
Happy emoji. That was pretty exciting. I started, you know, bringing all my friends on board, my Sunday school class, so everybody started becoming members. The cash on cash so far, so we still own this property, $255,000. That's how much cash we've gotten back on this property, and our current equity in this deal is about $700,000. So you add that up, $955,000, almost $1 million. Divide by the 80 I've got invested in, that's like over 100% every year we've owned this thing.
Is that powerful, guys? He did none of the work. He just got checks.
All right, second property, Austin property, a little 48 unit. I put 100,000 in on this one, and 2.5 years later, it turned into 328,000. The only thing the lead did, this is a yield plate, by the way.
Yep.
The lead added a little office right there, illegally, no permits. So.
You don't have to bring that up. I remember that, though. Bruce did that, yeah.
I think there's no bathroom in there either. I think the bathroom that the leasing manager had to use was either an empty unit or the Dairy Queen next door. All right, so those are the first two. Third property, so the third and final property of my first year of membership was another Austin property, 50,000 in, 3 years later, turned into 170. So average annual return, what, 80%? Not bad. The fourth one is interesting. So I actually took this one. This is money I took out of my 401k. So I know we're all taught that taking money out, paying the penalty and paying taxes is painful, and you're right, it was. But I did it at the beginning of the year, so February, so that I wouldn't owe the tax until April the following year. And I decided to make a chart that would follow what happened to this money.
Because he's an engineer.
Because I'm an engineer. All right, so we're going to follow what happened. So I paid about $17,000 in taxes and penalty to get that $50,000 to get into a deal. That's a lot of money, right? Worked hard for that. So the first deal went from 50 to 200,000 in 3 years. Quadrupled it. Not bad.
Really quick, I got to stop here. Do you think if he kept his money in the 401k, he would have done that? So the pain of pulling it off would have been more painful if he would have kept it in. Does that make sense?
So I took that money. Part of it got 1031. The lead tried to 1031 that into 3 different properties. 2 of them didn't close. 1 of them did. So about 55,000 went on to the Point on Redmond, which just recently sold this year, and we ended up with 112, so that doubled again. And then the rest of it, the 150, I became a lead, because at that point I was retired and didn't have anything else to do, and all my lead friends were saying, hey, join the club. So I became a lead. I did 1 deal, and it's a lot of work, and 3 years later sold it. Made a little bit of money and decided that that's it. I'm just going to do what John Pride does, stay passive.
Who likes the idea? He said, you know what, that's a lot of work. I just want to be lazy. Is that okay?
Yeah.
He's not a Bernie Sanders supporter, I promise you. Okay?
All right, so when that sold, that funded the next 3 deals, and 2 of those have sold this year, along with refis, and that's now funded 3 more deals. So my total equity from that 50,000 is now 600,000 plus 29,000 a year cash flow. Not bad.
Happy emoji.
Happy emoji.
I know this is very nerdy, but him doing it step by step, you can follow along of his investing path. And those of you already in some passive deals, your first year, you're like, I'm not making a return yet. I know, it got to go full cycle.
Yeah.
And that's what he's trying to show is the full cycle.
That was at 10 years. That was following that for 10 years. 2014, so I only did 1 deal in 2013. That was that money I pulled out of the 401k. The next year I did the same thing in February, right, first part of the year. Got into a deal, and that one did very well. This one I did a 401k loan because they'll let you borrow up to 50,000, and that one did very well. We still own that, equity in that, what, 178? Now this one where the out-of-pocket turns orange, so that's second generation money. So that's a previous deal that's sold to refinance, and I'm reinvesting it. Because you always reinvest what? Your seed corn, that's right. Okay, so the next several deals are second generation. And you can see kind of the point of this is to show that a lot of these deals are refinancing or selling, fairly quickly within 3 or 4 years of when I purchased them. And that's how you get rich, is by reinvesting your money, churning it quick.
Remember, I told you can't get rich slow. You don't just sit on stuff forever. You double and double and double. That's the goal.
Yeah, that first deal with that 700,000 equity sitting there, that's dead equity. And if I'm making 14,000 a year, but if you do the math on that, it's like 2.5%. So we keep bugging the lead. Well, maybe we should sell it or refinance it. We did just do a small refinance this year to get money to rebuild a burned out unit because we've been fighting with the insurance company for 6 years. We're taking them to court, and it should come out very well for us. But we're going to rebuild that unit and then sell it next year. Okay. So I started with about $405,000 from that sale of my house, plus the money I stole out of my 401k. That returned $2.1 million in cash. And we still have 1.25 million in equity. All right, so then 2015 through 2019, these are the next deals we bought. And the orange is second generation, that turns blue, that's third generation, purple is fourth generation. So it's just money being reinvested. The red ones on there, those are my IRA. So once I retired, I got access to the rest of my 401k, converted that to a self-directed IRA, and then put that into 3 deals.
And just so you know, just so you know, on Sunday when I talk about it, people always ask me throughout the weekend, can I use my IRA to invest? As a passive only, you can use self-directed IRA, but I'll explain the tax benefits pro and con.
Yeah.
Mike could do a whole dissertation on that. We don't have time for that tonight, but
Right.
he'll, we don't have time for that tonight, so.
So if you look at the average annual returns, my worst deal is like 7%, 7, 8, 20, so big range there. There's one red deal there, and that one sold this year. We lost money on that deal. That's my only deal out of my 74 that I've done so far.
Yeah, do you hear that though? I want to make sure people know that. There's risk in everything in life. 1 out of 70, is that a pretty good thing? So what's funny is, you know what people do in the end when we take questions? They're going to ask them about the one that lost money.
Yeah.
Instead of, what did you do across the board? That's what is your average return? Who understands that? That's how you look at a portfolio.
That one deal was a student housing deal outside of the model that they teach here.
Oh, gee.
Yeah, so we went into a deal with a lead that we knew very well, had done very well on my previous deal. He was the one that I followed that 50,000. That was his deal that quadrupled. We thought, what could go wrong with student housing? This is right before COVID, and all the students went home. So, and it's Huntsville, Texas, which is not a very.
And just so you know, Dell and myself, what's the model? Single-family rentals, multifamily rentals.
Yep.
No commercial, no storage, no student housing. This is the box. B and C class properties. That's what we buy. I know a lot of you don't understand. I'll explain that this weekend. If you stay in the box, it's safer. But it's okay. People want to go and play with Bitcoin once in a while or student housing. But it could have turned out great, but it didn't.
Yep.
Yeah.
Okay, 2019 through the end of 2020, we just continue to buy. My father passed away at the first part of 2020, so he had an insurance policy, and that's what funded kind of a lot of the stuff in 2020. So I stopped tracking the generations. So you see why the purple ends there. So from that 405, total cash returned $5 million coming back, and this is 11 years. And we've got 4.4 million in equity, 13,000 units. Cash flow was going to be about 200,000. A lot of my deals, recent deals, are seeing this increase in the mortgage rates. So they've got adjustable rate mortgages, and they're cutting back on their distributions for the next year. So that 200 may drop down to 150.
Okay. And that's tax-free income.
Tax-free income. Yep, we're getting there. Okay, so first couple years, this single family and a little bit of cash flow from multifamily, so it takes time.
And just so you know, he did do a couple single families in the beginning.
Did 5.
And he decided that's too much work. I just want to do multifamily from now on.
Yep, 2016, we sold them all and put it all into multifamily.
Yep.
So that third year is that first cash out refi. That's the big jump there. So orange is the profit. Year 4, we had those big sales, so almost a $600,000 year. Year 5, 6, and 7, it's a lot of profit. All that orange is coming back as refinances. The one blue is a sale. And then COVID hits, and we're still doing okay, but definitely not as big. Last year was an acorn shy of $1 million, and just did our taxes a month ago, and guess how much tax we paid? 0.
Do you know there's a technical term in the industry for that? Do you know what it is, Michael?
What?
Pee in your pants exciting.
Okay, I got an emoji for that.
That was a good one-liner for an engineer, guys.
And this year, so far, we're at about almost 1.5, and I've got 2 deals that are supposed to be closing for sale in the next several weeks, and we could approach 2 million. So I almost caught you.
That's awesome.
Passively.
Yeah, and remember, I'm out there hustling. I'm out there working my deals.
Yep.
He did absolutely nothing.
Yep.
I'm kind of jealous.
He made all his charts.
What?
He made all his charts.
He did make all the charts.
I
That
had to
took
do
some time.
that. You did have to do all those charts.
Yeah.
Okay.
Who thinks this guy's an engineer that worked on the space station? Hey, he's the one who made the chart how to pee in space. That's why they go in their suits now, okay?
Okay, cash flow by quarter. This used to be my favorite slide until I made that new one. So these are all the different colors are the different deals and the different amounts. And I want to point out here, we retired right here, and that's about $20,000 a quarter, so $80,000 a year. My wife didn't work, so normally you think, okay, once you retire, your income stops growing, right? Well, I wanted to show that my income continues to go up, even though we're not doing anything except reinvesting.
Now, this is very powerful, what he just said. I know what's going on, but I want you to hear this. What are we taught to do? Save up $1 million or $2 million, and then draw down at 4% a year. Who heard that before? That's what your financial advisor said. Till you're dying, you run out of money. And here's they call it the Monte Carlo or whatever, where you run out of money at 80 or 70 or 60 or maybe 65 if you don't have enough money. He's still doubling his money in retirement. He's still growing in retirement. That is super powerful.
Let's see, deals per year. So start off kind of slow, and it just accelerates. You get more deals, and they're refinancing and selling. Just keep reinvesting. So the last 2 years have been pretty big years. Okay, diversity. So we're being taught lately, right? You make sure you diversify your cities, diversify your states, diversify your leads. Don't put all your money with the same group and the same lead, the same city. Keep it diversified. So I'm in Phoenix, I'm in Tennessee, Charleston, Alabama.
And the reason he's saying this, and I'll explain it this weekend, is, look, we understand real estate's a great investment, but there's natural disasters.
Yep.
There could be floods, there could be hurricanes, there could be earthquakes, so this is why it's in multiple states, different sectors, different areas, different leads, because people can have heart attacks, people get divorces. Does that make sense? You don't put everything with one lead. Even if you've made them a 300% return 5 times in a row, you still keep going with more and more people. Everybody with me in that? And here's something, those of you passives, write this down if you don't know this. Never invest more money in a lead than the lead's willing to put in a deal. If he's only putting 100K, you put in 100K. That's one of my rules too.
Yep. Okay, I'm not going to go through all these. You can take a picture if you want, but these are kind of the things that I think about when I see a deal. Give you 5 seconds if you want to take a picture. Right? And I've got this printed out in a folder if you want to see me afterward. We can
take a picture of his folder out there.
Right.
Just like, who had folders? A folder full of women.
That was Romney.
Romney, yeah.
Yep.
No, it's binders full of women.
Binders.
Yeah. Okay, there's the nerds, political nerds. They get me.
So yeah, we bought our lives back in 4 years. I actually went to my boss. We were 3.5 years in. Things were going pretty well, and I said, "Hey, if there's an early retirement or a layoff package, let me know." So 6 months later, he calls me in and hands me a pink slip, and it's like, "Well, I hope this is good news." And it was a bit of a shock, but okay. So I took it and decided just to trust the system, and we stayed retired.
There you go.
No more Ostrich method of stress reduction. So everybody familiar with that? So when the market crashes, you put your head in the sand and just hope it goes away, in 8 years. Minimize your taxes in 401k. So I've been learning some things about how to get money out of a 401k to minimize your taxes. The first one, of course, is what I did initially, was just pull it out and pay the tax. Then you can convert to self-directed IRA. There are some tax consequences doing that inside the IRA. But one way to minimize that, if you do invest with value play in your IRA, and then you can actually pull the deal out of the IRA like partway through when the value has dropped, and that will reduce the amount of tax you owe when you pull the deal out.
Yeah, and just so you understand that, let's say we put 100K in the deal. When we first buy it, well, we're buying it upside down. A value play is a fixer-upper.
Yep.
So your shares might be worth $70K the next day on the books.
Yep.
So we pulled out then at the low value, so you don't owe taxes. Then when it doubles its money, it's outside the IRA. Now we do a cash out refund, you pay no taxes. So
Yep.
if you ever want me to teach a class on that, I can.
Yep.
Yeah. That's right.
Number three, something I just learned this past year when I had $1 million, I had $800,000 in capital gain. And I had way more than that in bonus depreciation losses. That's why we didn't pay any tax. I also pulled $400,000 out of my IRA. So I inherited an IRA from my father, pulled $400,000 out expecting to pay a lot of taxes. Turns out that when you have this capital gain and it's all wiped out by losses, it leaves this big empty bucket that you can put ordinary income into and pay capital gains tax rates. Capital gain tax rate is 0% for the first $80,000 if you're married, and 15% for everything up to $600,000. So my combined tax rate for that $400,000 IRA withdrawal was 9%.
God bless the IRS.
Yep. It was shocking.
That's
then,
as exciting as he gets, but that was really a good year for him.
yeah. And then to avoid that 10% penalty, I don't know if you ever talk about this, but you can, there's,
Some call it a quadro, we go for
Yep.
I teach that then. So.
yep, yeah, there's ways to get around that 10% penalty
Yeah.
if you're married.
Just so you know, how many people heard this before? And this is important. I like that he brought this up because this is how he got his money. You're only allowed to pull out 50,000 or 50%, whichever is less. Who heard that? Do you know there's a way to move from one spouse to the other? Let's say you have $500,000, you can move it to your spouse and not pay the 10% penalty. Who'd like to learn that? Come to my seminar this weekend. It's called a quadro. I'll teach you that. Okay.
Good. All right. So we built a new house a couple years ago. My kids have always wanted, they love those log rides, so we made a little lazy river. That's my one of my grandsons.
That's beautiful. That looks nicer than Dell's. Oh, we better not say
It's definitely not as big.
Not as big, but hey, it's your
Short-term goals, what did I say? Oh yeah, build cash reserves. So right now I'm going to be looking for some great deals coming up in the next 6 to 9 months. There's going to be some distressed properties, and we'll take advantage of that. And I also want to start re-engaging with some of the newer leads, because I'd been investing with long-time leads, and I need to get some fresh blood going, because these guys are all thinking about retiring and becoming passive.
Yeah, it's really neat for me because me and Mike knew each other for years. You know what I mean? We both were in San Antonio marketplace. So, you know, my kids were this tall, and now my kids are growing up. His kids went off to college, and they're second-generation investors now. My kids called you Captain Mike because you took us out on Lake
Yep.
Travis, was it?
Yeah,
So,
yeah. Initially, that's how I got to know the leads. I'd take them out on the boat. We were in a boat club. Just before I'm going to write you a check for $100,000, I want to know who you are.
Yeah, you want to know if he had to throw you off the boat or not.
Right. So
I was wondering why I was out there.
now, so that's it.
That's cool. Yeah, we could take a couple questions real quick. We'll take like two because I don't have time for it. If any in the passing room have a question or two, I can have Mike answer one or two. I can't believe nobody has a question. There's one right there. Hey, that used to be one of my biggest skeptics. He's going to ask a question. He's not anymore. He's good now.
I'm a fellow engineer, so I like your humor. So we're in 2 passive deals and 1 single family, and the way I'm understanding is when you get the big check, you reinvest it.
Right.
So you're living off the quarterly draws, correct? Because that's
Right.
how you make your income.
Right.
Yep, that's it. Simple as that. And he pays no taxes on that. This guy, you'll have to pry it out of me. He's in a John. He always says never eat your seed corn. In other words, don't touch that big chunk. Live off those distributions. That's what you can spend. And the thing is, you'll get to a point where if you're making like $500,000 a year in distributions, you're not even going to spend all that if you're frugal like me. You understand? So just keep scrolling. We have one over there. Let's get one over there. Let me get you a microphone. I'll do it. You can stay there. And then we'll move on. Here we go.
How do you go about picking leads in states, let's say, other than Texas? I mean, do you literally go and meet them all in advance?
So I meet them at the expo, typically. Yeah.
Okay.
Or at events like this. A lot of times they'll come here.
And just so you know, all of these lead investors have Zoom meetings. guys in Georgia, all over America, and you can just log into their meetings no matter where you're from. Because you got to realize we have folks investing from Hawaii. They've never even set foot in Texas, but they're in 30 deals. So I taught out in Hawaii. I taught in California. I teach all these places.
But I have invested in deals that I've not physically met the lead. I'm connected on Podium, on the website. Deal came up that looked really good. I called them, I interview them, and if I feel good about it, I'll invest. I wouldn't have done that in my first 5 years, but now I've got plenty of income, so I can take a little bit bigger risk.
All right, let's give Mike a hand. Appreciate it.